What's going on, guys? Welcome back to another video here. So in this one, we're going to be going over how the data that came out today, the CPI data, the core, the normal CPI, is some of the worst data that we could have possibly seen out of the market today. We're going to go over exactly why. We've been talking about this a lot, but these are things that you guys, not only as a participant in the equity market, in the stock market right now, but as a participant in the overall economy, there are some very key things that we all need to understand in order to protect ourselves from the things that are to come. So again, guys, if you guys do enjoy the information and analysis that I provide for you guys in these videos here, make sure you go down and hit that like button. It costs you nothing to do it, but it really helps us out a whole lot in getting this information out to as many people who want to learn. And if you guys do want to see more videos like this, make sure you guys hit that subscribe button down below too, and turn on that notification bell so you're notified every time I post a new video. So let's get right into the charts here and see exactly what has happened so far today. Now, currently at the time that I'm recording this, there's about an hour left in the market here. In the overall market, S&P 500, the SPY ETF is down about 3.7%. Now, I know a lot of you guys in our community with us made some absolutely insane gains today, and that's kind of what we're here for. But when we're looking at this chart here and exactly what's happened, well, we've seen this 1348 cross down on this daily time frame. We do have this key level of support here at around 393. Now, what I also want to quickly point out to you guys is the fact that we have recently seen a massive delta shift in the market. Now, don't get confused by that. It's really not that complicated, but when you think about overall market delta in terms of the derivatives market, if you see negative delta, there are a lot of bearish bets coming into the overall derivatives market. And if you see positive delta, it means that there's a lot of bullish bets coming into the overall market here. Now, recently what we've seen is the market go from pretty deep negative delta up to positive delta in a very significant move. And that is also why we saw these couple of days of green after we bottomed out at around 388. Now, looking at this chart here and a lot of the other charts, things are looking pretty bearish. Now, again, in order to navigate a lot of these markets, if you guys do want to join our community, we have a lot of awesome things to offer you guys. One-on-one training sessions, well, actually two-on-one coming up starting tomorrow. We've got all of those alerts, all of those proprietary algorithms that have been absolutely killing it. So if you guys are interested, make sure you check out that link down below. But when we're looking at the exact data that came out today, what we were talking about in some of the streams yesterday is that we're looking for the comparison between the normal CPI and core CPI. Now, the reason for this is that core CPI excludes food and energy. Now, we all know that energy has been an incredibly volatile asset class over the last couple of months, and recently it's been selling off pretty significantly. Now, what that leads us to believe is that, well, we thought CPI could have came in lower than expected, and that's why this consensus estimate for the US August consumer prices was negative 0.1%, but it came out at plus 0.1%. Now remember, we're looking at the comparison between the consensus and the actual of normal CPI, August consumer prices, and excluding food and energy right here, core CPI. Now, US August CPI excluding food and energy was up 0.6%, and the consensus was up 0.3%. So here's what this tells us here. There's a couple of things that we need to kind of go over, which we are going to kind of continue to talk about in this video here. But over the last month, if you've seen one of the largest contributors to inflation significantly decrease in price, and then you see overall inflation not come down, it means that there are other problems in the market right now that are not being addressed. What this also shows us is that the Fed's rate hikes here are not really helping all that much. And what does the Fed have to do in terms of its tools? Well, it has basically the runoff of the balance sheet and rate hikes. Well, if rate hikes aren't working and we are all expecting energy prices to significantly increase in the winter months due to what's been happening in Russia and Ukraine and cutting off the pipeline to Europe and the supply of energy, well, we could be in for some long and persistent inflationary pressures on the overall market. Now, when we come a little bit further here, we are taking a look at prices increases year over year. Fuel, 68.8%. Gasoline year over year, 25.6% increase. Electricity, 15.8%. Food at home, 13.5%. You can see all of these numbers here are pretty significantly positive. So we have seen a lot of inflationary pressures in the overall market, and we all know that this is a very significant problem. But where is a lot of these kind of price increases come from? Well, we can see that according to right here, this pink bar here, that a lot of these price increases has come from energy, and that even furthers the problem here that if energy prices have gone down and overall inflation has not, the Fed is losing all of their credibility. Now, why this is important is because we all have a good understanding of most likely what's going to happen at the September Fed meeting before today. Well, we all thought there was going to be basically a 75 basis point rate hike that was going to be coming through. And the key thing that we needed to look out for was the statements from Jerome Powell. Now, the statements were going to be critically reliant on the CPI data that came out today. If we saw CPI data come down a little bit, we saw core CPI potentially decrease as well, but not increase as much as it did today, well, we could have had Powell come out and say, yes, our rate hikes and our plan that we've laid out are working. But that's not what we're seeing here. We are seeing the exact opposite. And what did this lead to? A lot of fear in the overall market. And when you come over to this page right here, the Fed Watch tool, you can see that there is now, let's just quickly refresh this page, only a 76% chance of a 75 basis point rate hike when it was previously in the 90% range. But what happened? There's now a 0% chance, according to this watch tool right here, of a 50 basis point rate hike and a 24% chance of a 100 basis point rate hike. But what you have to think about here is that rate hikes are going to affect a lot of different things as a whole. It's not just going to bring down inflation. It's going to hurt a lot of company profitability in these margins of these large corporations. It's going to increase the value of the dollar. It's also going to increase unemployment. This is where we kind of come into the next really big problem, and something that we've been talking about a lot on this channel, and it's the problems of stagflation. If you then start to see higher unemployment and also higher prices at the same time and lower growth, which the Atlanta Fed has already told us that they are expecting, they've slashed their GDP estimate recently. Well, you get into that stagflationary environment, and that is a very, very large problem. Now, the other thing that we have to think about here is what are the overall economists at these large institutions kind of telling us about, okay, this is what we could potentially be seeing in terms of the Fed's terminal rate, where they are looking to stop raising interest rates. Well, previously it was around 4%. Now, today we're seeing something a little bit different. PIMCO economists Tiffany Wilding and Allison Boxer, joining their counterparts at Jefferies, said August Consumer Price Index reports points in favor of a Fed funds rate target that should end up higher than where many expected. They said they expect the Federal Reserve's forecast to be adjusted up to 4.5% in the terminal Fed funds rate next week, and called the August CPI data scorching. And that's exactly what it was here. You aren't seeing what the Fed is doing have really any positive effect on our overall inflation situation. You're only really seeing the negative effects of what rate hikes actually bring us. So when we're thinking about this entire situation as a whole, there's a couple of things that you guys need to keep in mind. Well, one, yes, the markets are going to be incredibly volatile, but if the Fed is going to be even more aggressive in terms of raising rates, we got to think about the housing market too. The housing sell-off could be even more aggressive, as when you raise interest rates with the Fed funds rate, you're also going to see mortgage rates increase as well. So when you look at this problem here, there's nothing really that the Fed or Jerome Powell can come out and say to really assuage anybody's fears right now. What is Jerome Powell going to say? Honestly, he's going to sit there, do his rate hikes, and say, we're going to look at the data as it comes in and act accordingly. But the tools that Powell has are pretty much been rendered useless after these last couple of months. So guys, that is going to wrap up this video here. If you guys did enjoy the information and analysis that I provided for you guys in this video, make sure you go down and hit that like button. It costs you nothing to do it, but it really helps us out a whole lot in getting this information out to as many people who want to learn. And if you guys do want to see more videos like this, make sure you hit that subscribe button and turn on that notification bell so you're notified every time I post a new video. So hope you guys are having a great evening. See you guys in the next one. Peace.